In the early 1970s, a relatively unknown manager named Peter Peyer at Texas Instruments published a paper that would completely upend modern corporate finance and eventually land him advising the President of the United States. He noticed a fatal flaw in how human beings and massive institutions allocate capital. We assume that because we spent money on something last year, we must need it this year. It is the financial equivalent of hoarding. Peyer proposed a radical alternative. What if every single year your budget dropped to absolute zero and you had to justify the existence of every single dollar you planned to spend? Today, we are going to deconstruct the mechanics, the violent corporate history, and the macroeconomic power of the zero-based budget, the financial doctrine of giving every dollar a job. To understand the revolutionary nature of the zero-based budget, you first have to understand the disease it was designed to cure: incrementalism. In traditional macroeconomic planning, whether you are the Treasury Department of a G7 nation or a mid-sized corporate conglomerate, budgeting is inherently backward-looking. Management takes last year's operating expenses, tax on a 3 to 5% increase for inflation or projected growth, and calls it a day. Imagine you own a shipping fleet. Incremental budgeting is like paying to maintain a ship that has been sitting in dry dock for a decade simply because you paid to maintain it last year. It institutionalizes waste. It creates zombie capital, money tied up in legacy systems, producing zero yield. The zero-based budget, or ZBB, is the exact antithesis of this. It demands complete financial amnesia. Under ZBB, the baseline for next year's budget is not last year's spending. The baseline is absolute zero. Every department, every project, and every individual dollar must be aggressively defended. It operates on a fundamental axiom: no dollar has a guaranteed right to exist in your portfolio. Instead, you must give every single dollar a highly specific, measurable job. Is this dollar assigned to yield generation? Is it assigned to risk mitigation, like a short-term treasury bond? Is it assigned to aggressive growth and research? By forcing capital to justify its deployment, ZBB violently reallocates liquidity away from bloated, depreciating assets and pushes it toward high-conviction, high-return ventures. It shifts a financial system from passive momentum to active, continuous optimization. Let's look under the hood at the unseen engine of this process. When you apply the zero-based budget at an institutional scale within a multinational corporation or a massive hedge fund, you are fundamentally altering the velocity of capital. Here is the chronological sequence of how this plays out in the real market. Step 1 is the forensic teardown. A financial entity strips away all historical context. The marketing department doesn't get $50 million because they had $48 million last year. They get zero. Step 2 is the creation of decision packages. Every manager must build their unit from the ground up, calculating the absolute minimum cost to survive, and then proposing incremental additions, ranked purely by their projected return on investment. This creates a brutal internal free market economy within the institution itself. Projects are no longer competing against their own historical averages. They are competing against every other project in the company for a finite pool of capital. This is exactly where institutional players like private equity firms weaponize ZBB. When a firm executes a leveraged buyout of a legacy brand, they immediately deploy zero-based budgeting. They are hunting for structural fat, administrative redundancies, private jets, inefficient supply chains. By resetting the budget to zero, they free up massive amounts of trapped cash flow. This freed capital is then instantly given a new job, servicing the massive debt incurred during the buyout, or being returned to shareholders as dividends. But the mechanics of giving every dollar a job extend far beyond private equity slashing costs. On a microeconomic level, it is the purest form of liquidity management. When an individual investor or a portfolio manager gives every dollar a job, they are eliminating lazy cash. Cash sitting in a standard checking account isn't just resting. In an inflationary environment, it is actively bleeding purchasing power. In a zero-based framework, that cash is immediately assigned a job, sweeping into a high-yield money market fund, rotating into sovereign debt to capture the risk-free rate, or being deployed into an equity index to capture market beta. There is no idle standing army. Every soldier is on the battlefield. To truly grasp the double-edged sword of the zero-based budget, we must examine the most spectacular and ultimately devastating modern application of it: the 2015 mega-merger of Kraft and Heinz, orchestrated by the Brazilian private equity titan 3G Capital, alongside Warren Buffett's Berkshire Hathaway. When 3G took control, they implemented their signature ruthless ZBB playbook. They didn't just trim the edges, they burned the forest to the ground. Managers were required to justify everything from massive factory expenditures down to the use of color ink in office printers. The initial numbers were intoxicating for Wall Street. Within 2 years, Kraft Heinz saw its operating margins expand from a sluggish 18% to a staggering 28%. Billions of dollars were suddenly freed up and assigned a new job, maximizing immediate shareholder value. But here is where the strict adherence to ZBB revealed its fatal flaw. By forcing every single dollar to justify its immediate short-term return on investment, Kraft Heinz starved its intangible assets. Dollars assigned to long-term brand building, research and development, and adapting to shifting consumer tastes toward organic foods could not prove a high enough immediate yield to survive the zero-based cut. The fallout was catastrophic. Because they stopped investing in the future to maximize the present, consumer demand plummeted. In February 2019, reality caught up. Kraft Heinz announced a staggering $15.4 billion write-down on the value of their iconic brands, slashed their dividend, and saw their stock price crater by 27% in a single day. The Kraft Heinz disaster proves a vital economic lesson. Giving every dollar a job is a powerful mechanism for efficiency, but if you only assign dollars to the job of short-term survival, you will inevitably bankrupt your long-term innovation. Zoom out to the macroeconomic landscape today, and you can see why the zero-based budget is experiencing a massive institutional renaissance. For the last 15 years, we lived in an anomaly, the era of zero interest rate policy. Capital was virtually free. When money is free, incrementalism thrives because the cost of corporate bloat and lazy cash is statistically negligible. But we have entered a new regime of structurally higher interest rates and tightened global liquidity. The cost of capital now carries a severe premium. Whether you are a central bank shrinking a balance sheet, a tech behemoth laying off thousands to prioritize artificial intelligence, or an individual investor navigating sticky inflation, the mandate is clear. You can no longer afford to let your capital coast on the momentum of yesterday. The zero-based budget is not just an accounting tactic, it is an economic philosophy of hyper-intentionality. It demands that you strip away legacy assumptions and confront the raw utility of your capital. Give every dollar a job. Because in a world where capital is scarce, a dollar without a purpose is not just idle, it is a liability waiting to be erased. So where do you begin? Start with your own balance sheet this week. Blank the slate. Forget what you spent last month on subscriptions, groceries, or index funds. Look at your total monthly cash flow as a pile of unassigned recruits. Force every single category to earn its place back into your financial life. If an expense isn't actively building your wealth or maximizing your utility, cut it. Your capital is a weapon. It's time to start aiming it.